Hello, welcome to this short video on capital gains tax. Thanks for watching. Our goal is to become comfortable with the framework for calculating capital gains tax in the event that you sell your commercial real estate investment here in the United States. So we're covering U.S. tax law for the sale of a commercial real estate investment. So looking at the framework, which is on the slide you can see, we're going to start with your net sales proceeds. So what you sold the asset for minus the costs you incurred in selling the asset. Now there's two key things that we're going to learn in this video. One is how we get this concept called adjusted basis or book value. So this is the accrual account of what the IRS thinks your asset is worth at the time you've sold it. So there is a accounting framework to get this concept of an adjusted basis, which provides the what the IRS thought it was worth, and if you sell it for anything more than that, you've made a capital gain in the eyes of the tax authorities, and so you will have tax to pay on that. Now, the second key concept in this lecture is how we calculate tax if we've made a capital gain. And what makes it tricky here is we have two marginal tax rates. One for accumulated depreciation over the holding period, and another one for gains that we make free and clear or anything above that depreciation that we've taken during the holding period. So it'll be a little tricky having to understand how we calculate our tax payable with two different marginal tax rates. And so once we've calculated the tax due from each of those marginal tax rates, we add the two together and it becomes our capital gains tax payable. That's a real cash flow. That is money that we've made in the sale that is now going to go to the government, not to our equity returns. So we put that cash flow in our capital gains tax due, subtract it from the equity before tax cash flows, again in the period of the sale. So this is only a one-time tax calculation. And that gives us our final period equity after tax cash flows. So this slide covers a lot of what I've just spoken, just puts it more into text. So key thing here is we've got two marginal tax rates. That's much different than income tax where you're just dealing with one marginal tax rate. And there's two items that we have to establish from the accounting world. So what is our adjusted basis? What does the IRS think the asset's worth? So another term for adjusted basis is book value. You may understand that more than the technical term adjusted basis. And we use that adjusted basis to calculate our gain and use those two tax rates. So let me give you a graphical example of that last slide. So again, capital gains only occur if our sales proceeds exceed what the IRS thinks the asset's worth. And that's shown graphically here by a capital gain equal exactly to the height of this entire column, all three colors, right? So our sales proceeds, our net sales proceeds on the top, right here, is what we've sold the asset for, net of our costs of selling the asset, and the book value is what the IRS thinks the asset's worth. So the entire column is the height of our capital gain, and in this asset we're going to cover how CapEx enters into the adjusted basis calculation, which it does, and how if we make gains above and beyond what we bought the asset for plus anything that we put into improvements, our capital expenditures, we'll then have a second marginal tax rate, one which is usually lower than the first marginal tax rate. And these are what we call free and clear capital gains, money that you've earned by an asset actually appreciating over time as opposed to depreciating over time. In the red is the IRS. Remember, we've been telling the IRS every year in our holding period that the asset's been depreciating based on the allowance given to us. This is when we the IRS gets to claw the tax back if you accelerated, or not accelerated, but depreciated the asset more than it actually is depreciated from the point of view of the market, which is usually the case because remember, depreciation allowances are tax incentives. So any depreciation allowance here in the United States that is recaptured at the end is taxed at 25%. It's a fixed rate. Now, for most investors, that's lower than their marginal tax rate. So, right, depreciation is great for commercial real estate. It allows you to defer tax to the end, to the sale event, and the next video will cover exit strategy and ways that investors can avoid this event ever happening. There are ways in the tax code to avoid capital gains tax altogether. And it also allows you to pay that deferred tax at a lower rate for most investors. So it's a win-win scenario for investors. Therefore, although it looks like you're paying a lot of tax here at the end, it's a lot better to pay a lower rate of tax at the end of our investment than to have had to pay the tax distributed through the entire investment period. Now I'm going to use some fancy drawing that I've done on an electronic whiteboard to go over the process of calculating our tax due. And remember, we've got two skills that we're trying to learn here. First is to understand in the world of accounting this concept of adjusted basis or book value. How do we know what the IRS thinks our asset is worth at the time we sell it? So we're trying to get to that purple number here in the corner, what we're going to call our adjusted basis. But we're going to start back when we bought the asset. So here's a fine little shop, if I say so. We're going to buy that for 250 grand, and that's net of our purchasing costs, or inclusive of our purchasing costs, because those go into cost basis. And that's the package, the building, and the land it sits within. From the past video, we know we can only depreciate the building, so I think my assumption here is that the building is worth 200 grand and the land is worth 50 grand. Again, you get that from a qualified appraiser. And so when you look at that and you divide it over a 39-year depreciation schedule, because this is a retail establishment that I've bought, that gives me an annual depreciation of just over $5,000 a year. So every year I write off $5,000 of depreciation. That lowers my income tax payable over the 5-year holding period. And when I multiply that annual depreciation by 5, I've taken over $25,000 in depreciation. So my asset has fallen in value in the eyes of the accountant. Now, I bought this to do a little bit of value add investing. So I've sunk $20,000 of improvements of my own capital into this investment. And that raises my adjusted basis, or raises what the IRS thinks it is, because I've put money into it to combat that depreciation and the value destruction that occurs over time. So now let's move to the right-hand column here, and let's do the accounting. So I bought the asset originally for 250 grand. I've claimed $25,000 of depreciation, so the asset is depreciated over time. But I sunk $20,000 of capital into it. That gives me my adjusted basis, or book value. So when I sell the asset at the end of 5 years, the IRS thinks I'm selling an asset that should be worth $245,000 roughly, if my depreciation allowance was not appropriate, but was exactly matched how the asset depreciated in the open market. So the next phase is, now that we have that key number, the adjusted basis, let's sell it. So I sell it, and we've got a sale, and that sale is at $280,000. So my value add investment did return a capital return based on what I originally bought it for, so we're happy. Successful investment. Now I owe capital gains tax, because what I sold the asset for, what its actual market value was on the day of the sale, was $280,000, but the IRS, remember, their books say, no, this is only worth $244,000. So therefore, I've made a capital gain of $36,751. So sales proceeds, right, net of selling costs, and subtract my adjusted basis, that's my capital gain, the blue number here. Now I've got a capital gain. Now I get to play this fun game where I have two marginal tax rates. So what's the tax I owe? Well, I first have to account for the 25% tax rate, which is the recapture of depreciation taken over the life of the asset. So this is where the IRS is clawing back depreciation that never actually occurred in the market. So what I always do first is compare my overall capital gain with that aggregate number representing the allowances and the depreciation that I've written off over the life of the asset. So remember the red number from the previous slide. This is the same red number. This is the 5-year depreciation, 5 years of annual depreciation that I've taken for this asset. That is less than the overall capital gain, right? So I've got $36,000 in gain, $25,000 of depreciation that I took. So I'm paying the full, I've reclaimed my whole $25,000 that I wrote off, so I pay tax on that full amount. If it's the other way around, if your capital gain is less than the amount that you depreciated, then we're only going to have one marginal tax rate, and it's this first one. I'll pay a 25% tax on everything because it's less than the depreciation I took over the life of it. So therefore, some of the depreciation I took actually happened, and therefore I never have to pay tax on that. But here I have a higher gain than my depreciation recap that I took, so I pay 25% tax on the full depreciation amount, $25,641, to give me just over $6,000 of tax payable. So that's my first number of how much tax I have to pay. But because my gain is more, I have to pay tax on the remainder of the gain. I don't get to claim the other $11,000 for free. I have to pay tax on that, but I get to pay tax at a lower rate. So that's good. So I take the price appreciation, so this is the capital gain, minus the depreciation. So I've already paid tax on that $25,000. I'm not double taxed here. That gives me $11,110. That's greater than zero. So I have to pay a 15% tax on that capital gain, or it's called price appreciation is the technical term, or free and clear capital gain. So this is money I've made above and beyond what my asset was originally worth, or what I originally paid for it, accounting for all the depreciation that I took as well already. So I pay, in this case, an individual investor would pay a 15% rate on this price appreciation gain, and that gives a tax payable of $1,667. So let's put it together. I pay $6,410 in tax based on the recapture of the depreciation, plus that $1,667 of tax based on my free and clear capital gain, so that green portion of the gain in that graph, the column graph you saw before, for a total capital gains tax due of just over $8,000. So that would be my capital gains tax payment that would be deducted from my equity before tax cash flows at the time of the sale, and therefore reduce my equity after tax equity cash return in that sale period. So that's capital gains tax framework for commercial real estate investing. Thanks for watching. Our next video will talk about tax strategy.